We are now deleveraging everything. Everyone will know exactly what their net worth really is.
Today, ladies and gentlemen, we're a day out for more inflationary data coming out of the U.S. Bureau of Labor Statistics, where we're seeing a tale of two stories. Coming into the inflationary environment, everyone was focused on such the long-term perspective of the technological advancements, whether it's coming out of Tesla, we're seeing Adobe, Shopify, all of them are kind of re-putting money back into their investment growth, slowing down their earnings. And again, with interest raising environment going on around us, we're seeing obviously constraints in spending, which obviously looks less, it's not that great, obviously, coming out of the earnings and the revenue growth we're seeing from our favorite tech stocks. But at the same time, you kind of got to ask yourself, is this temporary, and when are we going to see the end of it? But first and foremost, I have the pleasure to be joined by Lior Gauntz, the Chief Executive Officer of Wealth Research Group, who's going to offer us a little bit of insight, a guy that's been coming around on the channel for a little while. So first and foremost, Lior, it's a pleasure to get you back on, and I wouldn't mind getting your insight on what you think is going on in the macro environment that every investor is so fixated on, I think losing sight of the 3 to 5 year investment thesis. What do you see going on in the environment here? What do you think is going on with inflation? Just give us some insight.
In general, coming off of the great financial crisis in 2008-9, Fed and other old central banks basically cut rates to zero, and then left them there for too long, and that created an environment at some point. We can debate whether it was 2017, 2016, 2015, etc., where the premium for growth and the premium for assets in general, because there was so much credit out there, started to get frothy. But we got to a point where there was a lot of low inflation and very low unemployment, and that was a period called Goldilocks, which was the best economy we had in a very, very long time, especially in the Western world. But the shakeup from the pandemic and everything else brought it to the forefront that no matter what happens in the world, even a pandemic where, in March and April of 2020, people were thinking that the economy would be shut down for 3 years. Even then, governments and central banks came to the rescue like Superman, and people felt invincible. And you saw euphoria. You saw euphoria in everything. And people didn't save, and they started to spend. They started to invest. We all remember Rolex stores running out of watches, and lumber prices going off the charts, real estate prices going insane, specs and altcoins and the rest of it. And that is what the Fed is trying to stop. It's basically it wants to change the behavior so that it's not so inflationary, and that people understand there is risk. So they want to really put you where you really are. And where you really are is a different story at 4% interest rates than with 0% interest rates. So they're deleveraging all of the delusions that people had regarding, how easy everything is. Investing went well, this went well, your job, everything went well. Your job included options. You didn't like your job, get another job. There's always jobs. There's always everything. And it was all based on zero interest rates, which could work if people know what to do with the money and don't mismanage it. So once the inflationary genie came out of the bottle, this became a time to rein it in, and that's what they're doing. And there's going to be, and there's victims to that process, because if you all of a sudden got richer in the last 2 years, and you've sunk everything to the markets, now you have to ask yourself, well, which one of these holdings, or which one of my assets is really a good company and not a good company only at zero interest rates? So you have to really ask yourself these questions, because we're not going back to zero interest rates. It's done. We are going to live in a world of 5% interest rates for a very long time here. We've normalized interest rates in the world, and that's it. It's not going back to that experiment. We are now deleveraging everything. Everyone will know exactly what their net worth really is. In a world of normal interest rates, everyone will know exactly how safe their job is their employer a good employer, everything. The whole experiment of zero interest rates will be over, and this is like a big shakeout. And when it's over, sure, companies like you said at the beginning of the show, I don't remember exactly which ones, but world-class names. These are companies that, of course, will flourish afterwards because they're strong enough to weather this reset.
Yeah, and we're seeing that already, right? I mean, the large wipeouts happen, whether it's with crypto or anything super highly speculative. But the question, I think, is how bad it is and when is it going to start shifting around moving forward? Because everyone's throwing it out like, 4 or 5%, even 6% interest rates seem abnormally high, but they have been for the last decade. But historically, they're still insanely low, especially when you go back to the 80s and moving forward, right? And when you look at the savings rate across what a lot of the banks have been reporting, we're seeing higher savings rate. We're still seeing a better than expected jobs market. This isn't like a recession we've experienced before. And the real question, I guess, is how soft can the landing be when you're seeing a 20 to 30% correction in assets, whether it's real estate or stocks? And obviously that freezes everyone up from spending, but presuming people's jobs are still good and, what, depending on the part of the economy that's hit the hardest, I want to know what the next maybe 3, 6, 12 months might look like just from a speculative standpoint, because I feel like we've kind of gone through the eye of the storm at this point, and we're starting to come out on the other end where inflation is relatively cooled off to a pretty dramatic point from what we were seeing, depending what the Fed does with that and how long they're going to keep raising interest rates. I mean, at the end of it, what happens when they stop raising the interest rates? You see all the markets start to recool off from all the speculative that's been wiped out. And then we start seeing more spending and things nominalize. I'm kind of expecting that growth rates will start to nominalize as well and come back to a greater level than we're seeing. Because again, right, like when you looked at tech earnings, everything's constraining it. Facebook's down to an 8% growth rate from where it was sitting at an 18 to 20%. But again, when you look at ad spend, all of that's cooling, but eventually that's going to come back to a nominal rate. So you can't help but think that at some point there's going to be another bull cycle with those companies that have been left behind, that have been investing in that innovation, that are taking advantage of the value growth that comes out of tech, whether it's Tesla's robotics or Shopify investing into e-commerce, or Adobe or Microsoft buying Activision. Like all of that stuff will equate to further growth at some point down the road, especially if it helps when maybe it's 6, 12 months from now when the market nominalizes, we stop seeing these insane sell-offs. And everyone right now is just flooding into bonds and the US dollar, driving up the USD value, but inevitably all of this has to nominalize. What are your thoughts kind of just moving forward with this?
So we are not in a recession. We're in a reset environment of interest rates. Basically, if you really sit down and analyze your life and your own spending and the way you acted in the last 2-3 years, you will start to realize how many people put money in the markets, for example, when they really needed that money. But they said, okay, well, I'm just going to put it in the markets for a few months. I'm going to make money on it. That was like the mindset of everyone, and it's just an inflationary mindset. When everyone was thinking, well, you had that famous guy on Twitter saying stocks will only go up. Stocks only go up. Yeah, and he had a famous feed every day. It was like, I'm only at this for 10 minutes. I'm better than Warren Buffett, etc. The idea here is there was an invincibility and a fearlessness of investors, and that's basically what the Fed did not understand. It was like, these are supply chains. These are supply chains. This is going to fix itself. We have the best technologies in the world. We have it, but they didn't realize it's not the supply chains that were an issue, or not just the supply chains. It was our behavior collectively as a society. We were exhibiting inflationary behavior. To go out and buy cars and watches and stuff like that's not what the average person should do with his money, with his stimulus, with whatever. And so now they're taking down that wealth effect. Of course, if you are a responsible person, of course, you're suffering for no reason because you've not participated in this craziness, but you're now suffering because you're part of the basically the reset. So what they're trying to do is they're trying to centralize a solution, and that always has bystanders that are for no reason getting hurt by this. But in general, all we're doing is we're doing something very healthy, which is to say, hey, hold on, hold up, you know, there's risk in the market. Me, the Fed, is not there to save you. Me, the Fed, is there to do bigger things. And if you mistakenly thought that this is what I do for a living, I don't. I don't help markets. The dual mandate bullshit. So, in general, what I think is going to happen is China's slowing down. They're really having some sort of a recession. Europe is obviously in a big crisis, not only a recession, but a full-blown crisis. Those two regions are going to trickle into some sort of a slowdown in the U.S. I think what you need to watch are these unemployment numbers, because if they rise to 4.5, or 5%, I think that's when the Fed really will stop everything. But it may not even get there. We may get to a point in 2023 where there's enough stress on the markets that the Fed actually can't follow its plan of seeing the jobs market go to some sort of an equilibrium. Maybe it will be out of whack for a few years, and that's fine as long as inflation isn't crazy, and as long as we're in a recovery mode and not what we are in right now, which is this weird, crazy reset, very fast reset, aggressive reset to take people's mortgages from 3% to 7% in 6 months. That's just not responsible central banking. And so they were really late for a full year. Now they're catching up, and they're squeezing the life out of a lot of these industries, and that's just not good. So I think they understand that, and now they need to start to slow this down. So if the numbers come out tomorrow and they're a little lower than expected, let's say below 7.9, I think they might even not go through with the November 75 basis points. They may just do 50 basis points. But in general, we're definitely looking at an opportunity in all markets. I'll give you a story just so you can get my idea here. A fund manager called me and said, "Hey, we own an apartment building in Manhattan. We bought it in 2016 for $18 million. We put $6 million of our investors' money in, and 12 we borrowed. So the purchase price was 18. Fast forward, it's now 2022. Some of my investors won out because you give investors a 5-year business plan on most of these properties where you buy them, you take the leases expire, you do some renovation, and then you jack the interest of the rents, and then you sell that turnkey property to a pension fund or just a buy and hold type institutional investor. And some of his investors won out, but as a fund manager, he doesn't want to sell because he knows this is the worst time to sell. Everyone is in distress. So he was asking me, "Hey, do you want to buy just a portion from a particular investor who really wants out?" So I told him I'll take his position for half of what he paid in 2016. And he told me, "Hey, I'll get back to you." So he calls me a few hours later and says, "You got a deal." So basically, instead, I got in at a situation where it's almost as if the company, the investment was $3 million of equity and $12 million to borrow. So if they sell this property for $15 million, if they actually take a loss on this property, $3 million, I'm break even. If they sell for 18, which is what they bought it for 8 years ago, I make 100% on my investment. And that's how. And I asked him, like, why does this guy want out? He said he needs the money. If he needs the money, he should not have been there in the first place. And that's, I think, what was really wrong with the markets in general. On the flip side of this, once you do this big shakeout, yeah, for sure. As you know, some of these world-class companies with 20 years of growth ahead of it, with superior management teams, with everything you need in a phenomenal investment, they're really attractive right now. So for sure, if you were able to manage this right and you have the cash, this is a phenomenal situation.
Yeah, and I think you made a great anecdote when it comes to actually buying into real estate, and congrats on that deal. And I think a reason a lot of people might be getting squeezed is for a lot of stories that I'm seeing in Toronto, high valued markets where speculation was running rampant. I know people right now that were involved in fix and flips is that, you know, they put all this money into it, now they can't get rid of it, and they have variable rate mortgages because they were the lowest rates they could get, and now they're seeing their payments go up by $100-200 a week almost. And then you get, again, people, right, that maybe we're going to go buy a house, they signed to close in a few months, and then the bank asked for a higher deposit, and they didn't lock in the mortgage 3 months ago, and now the bank doesn't want to give them those mortgage rates, they can't close, and now they're getting sued and they lose their deposit. Like, so people, like you said, in the position of having some cash liquidity, they should be out looking for those deals right now. And I'm just going to kind of finish off where we started and just remind people that, you know, you can't kind of get caught up in the macro news as much as you got to understand that there's always an opportunity out there. I still largely just cost average into index funds, but when you start recognizing these companies that are trading off 80%, especially with things like, again, I'm not saying buy Shopify or Facebook, but you kind of got to look at those values and see that their historical PE levels, I was just talking about in my last video with Facebook, it's at levels it hasn't seen in decades. It's just kind of nuts. So you kind of have to just kind of look at what you have available, make sure you're not overspending, but definitely start taking advantage, whether it's real estate, stocks, and this is the opportunity, I think. And I think you have maybe 3, 6, I don't know if I'd stretch it out to 12 months, depending on what you said, kind of with the global environment and how bad that impacts our economies. But I feel like you're kind of in this window of opportunity where sell your bet if you have to, sell your shoes, sell your nice watches. Yeah, you might be taking a bit of a loss, but now's the time to be buying those premium assets and really take advantage of what I think could potentially become a new bull market in the next 3 to 5 years if you're patient, which you should always be looking into the long run. Stay cool, stay awesome, and as always, I look forward to catching you in the next one.